Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're taking a close look at StrongPoint ASA, that's ticker CRRO, and their Q2 FY25 earnings. And, following the release, the market reaction's been, noticeably positive. The stock saw a pretty significant upward move.
That's right. And just for context, StrongPoint is a technology company. They're really focused on boosting efficiency for grocery retailers, mostly across Europe.
Right.
They offer, automation hardware and also SaaS solutions, software as a service, really designed to help these grocers cut costs, which is, it's pretty critical in today's retail world.
Okay, so let's dive right into those numbers then. StrongPoint delivered a Q2 that mostly landed right where people expected. Revenue came in at NOK 350 million, which, exactly matched the consensus forecasts.
Right on.
And the EPS loss, NOK 0.07, that also aligned perfectly. But here's where it gets a bit more interesting for us.
Yeah.
Recurring revenue jumped a healthy 16% year on year. That's pretty solid.
That is solid.
And maybe even more impressively, EBITDA swung to a positive NOK 7 million profit.
Yeah, and that's, I think, what really stands out. It's not just about meeting the numbers, but that positive margin uptick, that NOK 7 million EBITDA.
Right.
It's more than just a figure, isn't it?
Yeah.
It's probably the strongest signal we've seen yet that their strategic shift back in late 2023. Focusing more on recurring SaaS and service stuff rather than big one-off projects. Well, it suggests that's proving operationally sound, like they're really leveraging their installed base effectively and building a more sustainable profit engine.
Okay, let's unpack that a bit more then. Looking deeper into the financials and kind of the strategic drivers behind it all.
Sure.
Total revenue grew by a very strong 18% overall.
That's significant growth.
Yeah, and we saw really excellent performance in the UK, up 45%.
Yeah.
The Baltics saw a 24% increase, and the Nordics were up 10%, with Sweden doing particularly well there. Now, that growth did partially offset a 16% decrease in Norway, but that was mainly because of those large electronic shelf label rollouts, the ESLs they had last year.
Right, so a tough comparison year over year for Norway specifically.
Exactly. And breaking down that recurring revenue piece, that 16% increase in their 12-month rolling figure was, significantly fueled by a 45% jump in license revenue.
45%.
Yeah. A big chunk of that came from the Sainsbury's contract, which started Q2 last year.
Okay, so that's kicking in nicely.
Right. And also strong contributions from their self-checkout solutions.
But
and that EBITDA improvement, it's quite a swing.
it really is.
Positive NOK 7 million this quarter compared to, negative NOK 9 million last year. So that's a NOK 16 million improvement.
Yeah, quite the turnaround. Now, last year's numbers did include NOK 10 million in restructuring costs. We should note that.
True, good point. But even if you account for that, you still see substantial underlying improvements across the Baltics, the UK, and Sweden.
Right, the operational improvements are there.
And it's also worth mentioning they capitalized 8 million in development costs, mainly for that CashGuard Connect project. What does that capitalization really tell you? Is that significant?
Oh, yeah, that capitalization is quite significant, I'd say. It suggests CashGuard Connect is, moving along nicely in its development. It's becoming less of an idea and more of a tangible asset that they expect will drive future revenue.
Okay.
And this investment, it's crucial because it directly supports those big long-term growth plans.
Right.
Shows they're putting capital behind these innovations they think will pay off big time.
Right.
And if you connect this back to the bigger picture, these financial improvements, they really do strongly suggest that the changes they made late 23, early 24 are actually having a positive effect on efficiency, on profitability. It looks like the start of a trend, not just a one-off.
And how did all this impact their cash flow and working capital?
Good question.
They reported positive cash flow from operations, NOK 20 million, which is always good to see. And they kept a relatively flat cash position quarter over quarter, ending at NOK 84 million.
Okay, stable.
But maybe more notably, they saw a decent improvement in working capital, dropped by NOK 5 million since the start of the year.
How'd they manage that?
Largely due to a big reduction in inventory, about NOK 33 million.
Right.
Seems they delivered a lot of those ESLs in Sweden, self-checkouts in the Baltics, and grocery lockers in Sweden.
Ah, so getting products out the door.
Exactly. Getting things delivered, which frees up capital. It suggests, a tighter grip on operations, even if it was partially offset by some increases in accruals and deferred income.
And it's good to see their net interest-bearing debt held steady around NOK 74 million. Plus, that equity ratio is strong, 46% against the 30% covenant.
Solid footing then.
Yeah, it really indicates robust financial health underpinning everything. That kind of stability gives them a good foundation for what comes next.
Okay, let's shift gears a bit. Let's talk about what management is saying about the road ahead, their strategic priorities.
Right, the outlook.
CEO Jacob Tverabak, he reaffirmed their long-term financial goals. Healthy revenue growth and an EBITDA margin over 10%.
The target.
Yeah. He did acknowledge, though, that while they'd hoped for maybe faster improvement, they are pleased with the traction they're seeing now. But thinking about that 10% margin target, what are the biggest hurdles you see for StrongPoint in actually hitting that consistently? Where could things, maybe fall short?
That's a really good question because hitting 10% consistently, especially in retail tech, it's not easy. I think the biggest hurdle is often just the sheer pace and complexity of these large-scale deployments, like Sainsbury's, like CashGuard Connect.
Right, huge projects.
Exactly. Each one needs pretty much flawless execution. Any delays, any hiccups, they can impact revenue recognition, cost efficiencies, you name it. Plus, it's a competitive space, right?
Yeah.
So they constantly need to maintain their tech edge and keep growing that recurring revenue base. Those are the big challenges, I think.
Makes sense. Execution is key.
Totally.
So let's talk about some specific wins they highlighted on the call. Key customer successes.
Okay. First, a major one with Carrefour Belgium for their order picking solution. This feels significant because it really shows off StrongPoint's ability to scale internationally, like way beyond their usual 9 core countries.
Yeah, opens up new markets potentially.
Second, they sold over NOK 20 million worth of these AI scales to a Nordic grocery retailer. Apparently, these scales give instant product recognition.
Oh, interesting. How does that help?
Well, it solves a common headache for customers at checkout, like what kind of apple is this? And it eliminates errors, saving the grocer money.
Oh, okay. Smart. Tackling shrink and customer experience at once.
Exactly. And third, they strengthened their position in the Baltics with Coop Estonia, adding another 130 self-checkouts. This kind of cements their status as the go-to-market player there for that solution, shows that deep customer intimacy strategy they talk about. Right. And these wins, they really are proof points for StrongPoint's core purpose, aren't they? Helping grocers solve those 5 key problems. E-commerce efficiency, dealing with theft and shrink, improving general store efficiency, handling pricing and promotions better, and streamlining cash handling. Looking at those 5, which one do you think is maybe the most critical for grocers across Europe right now? And why do StrongPoint solutions stand out there?
Ooh, that's tough. They're all pretty crucial. But if I had to pick one, maybe theft and shrink, closely followed by store efficiency.
Yeah, margins are tight.
Exactly. With inflation, every bit counts. Losing stock to theft or just inefficient operations hits the bottom line directly. And StrongPoint solutions like those AI scales cutting errors or the self-checkouts maybe reducing queues and staff overhead, they directly target these high-cost pain points.
So it's not just cool tech, it's about measurable savings.
Precisely. They're selling ROI, essentially.
Makes sense.
Okay, on the long-term strategic project front, Sainsbury's, that rollout is still obviously a massive focus.
Understand.
Management called it probably the most important customer win in StrongPoint's history. Big words. They think it'll open doors, build credibility.
Huge validation if they execute well.
Right. The completion target is still summer 2026. They expect more store implementations before the Christmas retail freeze, and then ramping up again into early Q1 next year.
Okay, steady progress there.
Then there's the CashGuard product, specifically for Iberia. This is meant to be a kind of revolutionary cash automation solution. They're developing it with the largest grocery retailer down there.
Aiming to really cut costs and headaches around handling cash.
Exactly. Piloting is ongoing, the latest version is being tested now, and they're getting ready to test it with multiple checkouts, moving towards industrializing production.
And what's interesting here is how these big strategic projects, even though they require ongoing investment like that NOK 23 million in CapEx you mentioned for CashGuard Connect.
Yeah, significant spend.
They're absolutely critical for the future, right? For future growth, expanding that recurring revenue, and ultimately hitting those long-term profit targets. It's investment today for growth tomorrow. These are the big bets that could really shift their trajectory.
So bringing it all together, what does this mean for investors? The market certainly seemed to like what it heard.
It did.
The stock reacted positively, closed up 3% on triple the average volume after the call.
Strong reaction.
And what's compelling is that this move seemed driven by StrongPoint itself, by the company fundamentals, not just the whole sector moving up. Pure retail tech names were pretty flat that day.
Right. Company-specific news driving the stock.
Yeah.
And the market sentiment, I'd say, is cautiously upbeat. No nasty surprises in the numbers, plus a clearer path emerging towards margin expansion.
Yeah.
That seemed to prompt some light buying, ease the implied volatility a bit after the call. And zooming out, this Q2 reaction, it actually extended what was already a pretty impressive 3-month run for the stock. Shares were up roughly 15% since late April.
What was driving that before the Q2 results?
News like hitting that Sainsbury's order picking milestone and launching that NOK 40 million share buyback program. All that pushed STRO to fresh 52-week highs even before this earnings report.
Okay, interesting momentum building there. Now let's move to our This Is Not Financial Advice segment.
Always important to state that clearly.
Absolutely. So looking at StrongPoint's consistent progress on recurring revenue, these key new wins like Carrefour and the AI scales and the, ongoing development of CashGuard Connect, a potentially bold way to think about this could be initiating a long position in STRO.
Okay.
And maybe for those with a higher risk tolerance, even considering some aggressive options strategies, maybe looking at out-of-the-money calls expiring late next year, something that only really pays off if the stock makes a very strong upward move.
A high conviction bet then. What's the core thesis behind that kind of play?
The thesis would hinge on, say, the industrialization of CashGuard Connect really taking off, or perhaps landing another massive international e-commerce win, something that accelerates that EBITDA margin expansion way beyond the current 10% target and much faster than the market expects right now, catching a significant upward re-rating in the stock price as a result.
Okay. So banking on significant upside surprises. While that upside is definitely clear if these strategic initiatives fire on all cylinders, you'd really want to keep a close eye on the execution, wouldn't you?
Absolutely.
Particularly that industrialization phase of CashGuard Connect and the actual pace of the Sainsbury's rollout. Those are key de-risking milestones. This kind of strategy really assumes StrongPoint keeps executing, flawlessly on these pretty complex deployments.
And flawlessly is asking a lot for projects this big, isn't it? What are the main risks people should keep in mind if these rollouts hit bumps in the road? Oh, absolutely. Flawlessly is a high bar. Key risks. You could see integration challenges with the retailer's existing systems, maybe unforeseen technical bugs pop up during the large-scale deployment phase, or even just slower than expected adoption by store staff or the end customers.
Right.
Any of those could push out the timeline for seeing the revenue and profit benefits. And that would almost certainly put pressure back on the stock price. It really does come down to execution.
Okay, good dose of realism there. So to wrap things up then, StrongPoint delivered a solid, pretty much inline Q2, but with really promising signs of margin expansion starting to show through.
Driven by that increasing software mix and better cost control.
Exactly. And it's all underpinned by those strategic customer wins and, of course, the big long-term projects like Sainsbury's and CashGuard.
So a final thought, perhaps. If StrongPoint's whole purpose is making grocers more efficient, what other areas within retail operations do you think are ripe for this kind of tech disruption? Where might they potentially look next? It's an interesting question for their future strategy. It is indeed something for listeners to ponder. And remember, everyone, this deep dive is strictly for informational purposes. It is definitely not financial advice.
Please do your own research.
Absolutely. Always continue your own research and exploration. Thanks for joining us on the deep dive.